Most small B2B owners, solopreneurs are flying blind with their finances, and that's a pretty bad place to be. If you don't know what your cash position will be 3, 4, 5 months from now, then it's very difficult to make long-term plans, to invest in your business in the right way, to anticipate how much cash you'll have in the future. I have built a tool for this and I wanted to share it with you. The link will be in the description or in the comments to this video or podcast episode. And I wanted to show you how I can do cash forecasts and always be very comfortable, fully knowing that I know how much I can invest in my business. And with this tool, I can, for example, project my monthly expenses going forward. I can run scenarios. What would it be if I make 20, 40, 50, 60K a month? I can also flexibly insert ad hoc one-time expenses and see how it impacts the rest of my year. I can easily track cash status on all my bank accounts. And also at the end of the month, I can see if I projected something wrong and make corrections for the future. All right, let's get into it. I'm going to jump into my screen recorder and I'll see you there. So this is the tool. I call it the Alpha Lead Academy Cash Forecast tool. And this is what it looks like. It's very, very simple. Let me quickly explain to you the mechanics. Here in this column where it says out, you simply put in your cash outflows. And it's really important that you do this on a cash basis. This becomes really important in terms of your revenue, which we're going to get to in a moment. But it's all about the cash that comes in and the cash that leaves. So it's not about, future commitment. If somebody pays you, they commit to a $10,000 deal, but it's going to be over the next 6 months and you're going to spread it out over 6 months. Well, that means you cannot put 10,000 in here at this point. It needs to be spread out over the following 6 months, right? So cash-based accounting, hopefully that's pretty clear. Shouldn't be too difficult. All right, so here in this column, you see this cell here. This simply sums up everything that starts at row 10, right? So here you can see sum C10 to C1000. This also means that you can very easily just add something to it. Let's say you just, some unexpected expenditure, you just put it in here and you say, unexpected or whatever, car repair. I had that already. Let's say pool repair. Let's say you already have a pool. And you say minus 10,000. Right? You put that in here. Suddenly this number adjusts because obviously it adds up everything else. Okay, it's basic spreadsheet technique. All right, we can just delete pool repair. It's not as relevant. And so here we are in January. You can see we have out 5,600. We don't have anything in. And so let's say at the beginning of January, you sign a new client, and they will pay you $2,000 a month. But of course you have Stripe fees. So you just don't put in 2,000. You just put in, let's say 1,900. And you then project that out. This is from January. And let's say that you have a 3-month minimum retainer. So you go client 1. You're going to go here 1,900 and you see suddenly this has now changed. This is 1,900 in, 1,900 in. And here again, you say, you should probably give the client a name. So client John, right? Just so you can identify it. And you put in 1,900 it was, right? 1,900. And because you have a 3-month retainer, of course, everybody could always still end a specific retainer. It's not cast in stone, but once you have a 3-month retainer signed in writing, it's more likely than not that they will actually stick with it. And so you can then do a rolling retainer like this. Now, once you get to February and they haven't canceled and you have a rolling 3-month retainer, then of course you can add the next one in April. Okay. And this is how you can forecast your cash. Of course, if there's, for example, tax included, you need to include it because it's cash in. But if you know that you will, for example, have to pay 20% of this at the end of June, you can say, for example, here you will have a new out thing, right? We're going to insert one row here, tax for client John. And let's say here we can reasonably assume that he's going to stay for 6 months. You always want to be very conservative and very cautious when it comes to outflows and be less optimistic, also conservative, about inflows. So always assume more will be going out than coming in. So here you say tax for client John, and you can just add to it 6 months, Jan to June. I have to look over my microphone so I don't see my keyboard really well. So this is the tax, and let's say it's 20%. You just put here, and you always have to do minus because obviously this is a negative figure. It's an outflow. And so we can do 1,900 times 6 times, and let's say sales tax is 20%, would be 20%. I know the math is not perfectly correct here, but it's always better to be more conservative. And that is, close that, and this would be the sales tax that you then have to pay. And you just leave that thing in, and every time you get to a new month, let's say it's the end of May, you can then check, okay, is this still relevant? Has John stayed with me? No, John actually left after 3 months. So let me quickly correct this because he was only in for 3 months. And this is a tax that I now will have to pay, right? That's the whole idea. And if you realize, okay, this is my status, I'm going to be at, let's say 16,000 at the end of January. Given my expenses, I need way more clients because otherwise my bank account status is decreasing rapidly. And you will just add new clients in here. You know how much is going out, and you will then see that this number, when you have status, the status that is starts to be negative. Here you have May, status at the end of May. As you are adding more clients up front, the time of the status going negative will push further out. So let's say that you will not only have John, you will also have, this is here, new client, John. Let's add new client, Jim. Okay, so new client Jim, you're just going to add another, let's say 1,900, boom. And now you see the status in May has now decreased, right? As in we are less in the red in May just because I added this new number in. Because why also? You have to explain the mechanics of it. Status simply looks at the starting point, adds the out figure, adds the in figure, and then calculates a new status. And you can then always check at the end of the month. This is how you can account for the money that you have in the bank. You can then see, okay, on the 31st, you have it in your calendar that you put in all bank account statuses. Stati, I don't know if that's the right word. You put bank account, we have 3,000, we have here 8,000, and in bank account 3, we have whatever, 7,654, right? And then the total, you can then set up here. This 18,654. Look, we have a little bit more. We were quite frugal. And so then what you do at this point, once you are on the 31st of January, you just go equals, I have a new keyboard. You just go here equals 18,654, and this becomes the new status, right? Once you're at the end of January, this is for the year 2024. This is the new status, and this will then, of course, adjust the statuses over the subsequent months. Okay. This is also a great way of seeing, well, how much was I actually spending? I was projecting that the fixed costs were 500, but maybe I stopped using a couple of tools. So this number was actually lower. So if then I see, okay, what was the difference? Sometimes it's not really relevant. Like now, it was the difference of a couple of $100. It's probably not worth investigating. But especially if if it's more than 500, 1,000 that you are short every month, you want to investigate why that happened. And then you will see, okay, so I put 500 as the fixed cost for the business, for software and so on. Well, was that really the case? And then you can go through all the line items. So you do that in a separate sheet, but just calculate and see, well, how much did I actually spend? Or has my insurance gone up or down? My consumables, did I have the car cost actually much less because we weren't really going anywhere? And so all of that you can then account for and retroactively see, well, how have my real expenses been? And this tool has helped me enormously, especially in my leaner months when I was starting out, to know how my cash is going to look like at the end of the month, at the end of the year, and projecting out what was my financial runway. So I hope this is useful to you. The link to this is in the description or in the comment section. Give it a like. And if you ever need any help with it, if you don't understand something, just contact me on LinkedIn. If it's a quick question, I can easily answer that, and it's going to be useful for me because I see how people are using it and if there's any problem with it that I can help them with. Cool. Hope this was useful. See you around in the next video. Give the video a like, leave a comment so that other people can discover it as well. And I talk to you soon again.